Hola, mi amigos. Mi nombre el Max Pizio, el Chaniel, el Trades and Ganos. I'm just kidding. What's up, everybody? This is Trades and Gains. I'm your host, Max Pitts, and today we have another exciting edition of what I like to call our Flow Review Show. This is a show where, well, we talk about what Wall Street is actually doing, not what it's tweeting, not what CNBC is screaming, and definitely not what your favorite perma bull with a podcast mic taped to his forehead is selling you. Because this week's options flow, yeah, it's not screaming to the moon, daddy. It's whispering, maybe don't YOLO your rent money just yet, Tyler, and go make some more sports bets. Welcome to the weekly options flow reality check. I'm your host, Max Pitts, the finest, the smartest, and the sexiest analyst on Twitter. So here's the headline before we zoom in. Indexes, they're getting hit with protection. And no, I'm not talking about condoms. I'm talking about that good old protection, brother. Commodities, they're getting all that love. They're getting the cousin loving, the mama loving, the sister loving, and your favorite actresses loving. All right. Big tech is being selectively hedged. This is not panic. This is what we like to call caution with the spreadsheet. All right. This ain't your normal caution. This is caution with some macros and Excel formulas and pivot tables running through them. The translation here, smart money, it's not scared. It's not scared at all. They're just not buying the story anymore. So let's go ahead, make like a deep sea diver and dive straight in. All right. So let's go ahead, kick things off. Who was our winner of the week? SPY, of course, because it wins pretty much every week. It's kind of like the Miami Heat with the big three. It's just expected to win, okay? We had 276.75 million in total overall flow with only 27 million in calls. Yes, only 27 million. That's like taking a piss into the ocean. No real effect, because we saw 249 million in total puts, with our most popular contract getting smack-a-loodled 55 times, not 65, 55, all right? The 670 puts due for June 18th of 2026. That was our most frequently traded contract. That's not a hedge. That's the group chat meeting up in real life, all right? This isn't the, I think the market might dip. This is, I'd like insurance in case Jerome Powell sneezes, sir. What this tells us, though, funds are protecting gains, dealers are long gamma higher, short gamma lower, rallies are likely to get sold into, and this is risk management, not fear, okay, babes? And that's more dangerous for the bulls. QQQ, same love, different glove, baby. 126 million in total overall flow, 35.53 million in calls against 91 million in putantes, in puta madre, okay? And these are the February 27th, 2026, 595 puts. That was our most hit contract on QQQ. Let's actually talk about the biggest contract that we saw traded as well, because I think that gives you guys some perspective. 13 million in the same, but 130 2026 595s as well. Now, this flow is a very clear imbalance, people, and we like to call QQQ in the community SPY with feelings, okay? Translation, we like tech, but we don't like it at these prices. That's all this tape is telling me right here. It's just it's speaking to me, okay? This is what happens, though, when, well, rates won't die, earnings expectations are stretched, and everyone already owns the same 7 stocks. What do you think was gonna happen? It's called oversaturation. It's like when everyone bangs the same girl. Eventually, they're all gonna get tired and hedge with a different one, right? This is what we like to call position trimming, not not a hard exit. Let's just say it's not a hard exit whatsoever. Now, the next in second place, shockingly, because let's be honest, IWM has been getting no love. And the only time it does feel the love, you know, like the tender touch of an uncle, is when rate cuts are coming up, right? So 170 million, 75 million in calls against 95 million in puts. Now, our most hit contract on this guy, right? Let's look at our most hit contract. Oh boy, the 249 puts due for February 20th of 2026. Now, if we also look at our biggest contract here, well, 252s, okay? Only $3 less than our most hit contract. Now, what is that telling me? Well, rate cuts aren't on the table, babes. And guess who the only index that really benefits, that really gets their rocks off during the rate cut times? Well, that's IWM. You want to know why? Because they're poor. They can't afford these higher rates for longer. They're gonna drown. They're gonna have to lay off Karen with her 6 kids, okay? Because they can't afford these high prices. So that's IWM, babes. It's not looking pretty because guess what? Those rate cuts, they ain't coming, brother. They is not coming to save you. Now let's talk about some precious metals, okay? We had GLD with 111 million in total flow, 96 million going into calls against only 14 million in puts. On the silver side of things, we had 83 million in total flow, 69 million going into calls against 13 million going into puts. That's what we like to call good old rotation. That ain't no speculation there, brother. These people are rotating and gyrating and making them work for the money. Now, on the GLD side of things, our most traded contract and our highest premium with a whopping $60 million for January 30th of 2026 were the 455 calls. Again, 60 million. That got them 137,000 contracts. Yes, 137,000. Okay? That was our most traded contract. On the silver side of things, yes, it's a little less sexy, but these $95 calls got 10.29 million dumped into them, giving them 11,000 contracts. All right? Now, this isn't gold bugs on Twitter, by the way. This isn't even your favorite FinTwit influencer trying to flex they made 100% gains on a position. This is institutions saying, hey, you remember inflation? Maybe it's not dead. In context, it very much matters. PCE, it's still sticky like that post-nut clarity. Rates are refusing to collapse. Equity multiples are stretched out like your favorite cheerleader, and gold and silver aren't being traded like memes. They're being treated like insurance policies right now. Now, next up, we have NVDA. NVDA came in with 78 million in total overall flow, with 58 million smacking those calls against 20 million and the puta madres, okay? Yeah. Here's the nuance though. NVIDIA is still being owned, but it's also being managed at this point, all right? And when I mean managed, it means people aren't just blindly buying into this thing. It's turning into a narrative stock, babes, because they need to push the button forward. They are the horse leading the cattle, all right? Now, our most traded contract, the 250s, saw 10.34 million dumped into these. Granted, $3,400 average, but they still netted about 3,000. We also have some 180s due for 115 of 2027. These, by the way, are very long out, so keep that in mind. That's what we like to call managed. That's menaging, all right? We're menaging here. So this is call spreads, trims, and risk-defined exposure, not YOLO upside, okay? This is not GTC for the first time where everyone creams in their jeans and has to go change midway through the conference. Now, the translation here, we're not dumping it, but we're not marrying it either. It's kind of like, you know, that hot girl you were dating in college. Ain't that right, Kyle? Anyways, that's a huge tonal shift from last year, because if you remember, basically you could just buy NVDA and sit on it for a couple months and make some money. You know what I mean? Now let's talk about Tesla, okay? Tesla had 47.7 million in total overall flow this last week, with our highest traded contract, $410 puts due for June 17th of 2027. That is, again, far and outdated. That's like buying fire insurance in Alaska. You hope you'll never need it, but you'll be happy if you do, right? Now, on the upside of things that are a little closer to us, I would say January, February, March, April 17th, 2026, 475s, 2.64 million at 830.50 average. All right. Look, there's more calls than puts here, folks, and they came in at a lower frequency. This is retail plus hedge fund tourism. Nobody knows what Elon's doing at this point. Let's be honest. You don't know. I don't know. Your mother doesn't know. We're all just farts in the wind and hoping for the best at this point. Now, that doesn't necessarily mean Tesla is gonna tank, but nobody's trying to pretend that they know what Elon's gonna say next. So this is what we like to call optionality, not conviction. All right. Now, next up, we have Intel Corp, the sneaky one. And no, I'm not talking about that type of sneaky. Get your mind out of the gutter. This is one of the most interesting flows. Now, I will say off the bat, I hate Intel. I think it is a garbage stock, okay? 30 million in total overall flow, 28 million in calls against 2 million in puts. That's what we like to call directional, unfortunately. And this lines up perfectly with earnings that were coming up, the CHIPS Act tailwinds, and some foundry optimism, which, by the way, all that got crushed after their earnings call. Intel's still a garbage company, so good luck if you support that and if you are bullish, because until they get a foundry customer and can ramp up their production speed, yeah, buddy, this is a hopium trade. And institutions realized that on Friday when that thing dumped 17% post earnings, because they aren't able to actually keep up with the demand. And, oh, that NVIDIA partnership you all keep talking about, yeah, they stopped testing those 18A chips. So that needs to tell you everything you need to know, all right? Because guess what? Institutions aren't betting on fireworks. They were betting on competence, which Intel showed they had none during their earnings. So, like, Intel just needs to show that they somewhat know what they're doing, and people would actually respect them more. But they can't even do that. So, if you're bullish on Intel, go ahead. My Cash App will be in my bio. You can just send the money to me. Anyways, what does this all mean? Let's go ahead and make like a condom and wrap it up. This isn't risk on. This isn't even panic. This is what we like to call hedged, selective, defensive with upside optionality. This is late cycle behavior, okay? When everyone's bullish publicly, but hedging privately and rotating into metals, that's when markets chop, not rip. So here's what traders should be watching next week. 1, rallies into resistance. Those are suspect, especially if SPY keeps seeing downside protection. 2, the gold trade, it matters. If gold holds while equities stall, that's confirmation, not coincidence. 3, earnings volatility over direction. Names like Intel, NVIDIA, and Tesla are being positioned, not chased. 4, watch that dealer gamma. And by the way, if you want to watch some dealer gamma, all you got to do is go on over to Apex. We got all this good old gamma data for you to, you know, put your fingers deep into. Now, once these hedges roll off, things can move fast, and that's either way. It's bi-directional, babes. So, Wall Street, this week, it wasn't drunk, even though it seemed like it. It's not even euphoric, and it's not terrified. It's sober, cautious, and side-eyeing the weak. And historically, that's when markets stop rewarding optimism and start rewarding discipline. Anyways, make sure you like, comment, subscribe with your hottest take under the comments. I hope you guys are all having a great Saturday. I'm currently on stream at Free Wi-Fi Radio, so come and feel free to hang out for the day. Maybe we'll do some gambling. I don't know. We'll see. Anyways, like, subscribe, comment, share this with your best friend, and I will see you guys in the next episode. Love you.